This video is called The Truth About Offshore Investing, Why the Swiss Win. And if you clicked on this because you want to know what kind of investment returns you can get offshore, or what kind of investment returns you can get inside of an offshore trust, I'm glad you're here, because the honest answer is probably not the answer most people expect. And understanding that difference can save you from making a very expensive mistake. Now, before we go further, let me tell you why I'm even qualified to talk about this, because this is not theory for me. I've been in the asset protection and offshore planning space for about 35 years. My company's Lawyers Limited law firm and asset protection planners have helped clients set up over 1,000 Swiss bank accounts and thousands of offshore structures around the world. So we're one of the largest firms in the United States that helps people do this properly. And when I say properly, I mean legally and tax compliant. That's a big deal, because there's a right way to do offshore and there's a wrong way that can create serious problems. Everything we do is designed to protect assets while staying within the law. So what I'm sharing with you today is not something I read in a book or heard from somebody else. This actually comes from decades of working with real clients, real money, real situations, and seeing what actually works and what doesn't when things get tested. Now, most people approach offshore investing with the wrong mental model. They hear the word offshore and they think bigger returns, secret banks, special investments, or some magical place where money somehow grows faster because it crossed a border and got on a plane. This may be partially true, but it is not how sophisticated offshore investing works. In fact, one of the freshest and most important truths on this subject is that people who tend to do the best offshore over the long period of time are usually not the people trying to hit the highest returns. They're the people structuring their money so it survives, compounds, and stays hard to reach when life gets messy. And that is one of the reasons the Swiss win. And if you appreciate this information, please click the like button so they promote this video. Many thanks. And please click the subscribe button if you haven't already, so that when more videos come out like this, you'll get notified. And if you want to protect your assets, set up an offshore trust, or you just have questions, visit us at assetprotectionplanners.com and you can get a lot of free information there. Okay, now let me give you the problem, the payoff, and the path very quickly. The problem is that affluent Americans often ask the wrong question first. They ask, what return can I get offshore? The payoff is, by the end of this video, you're going to understand the better question: how the Swiss, Luxembourg bankers, and Liechtenstein wealth people tend to think, and why offshore planning can improve your long-term outcome even when the headline return number doesn't look flashy. And the path is simple. I'm going to walk you through how real offshore investing should be evaluated, what offshore changes and what it does not change, why the Cook Islands Trust matters, and what wealthy people commonly misunderstand until it's too late. So let's start with the wrong question. What return can I get offshore? Now, on the surface, that sounds perfectly reasonable. You worked hard, you built money, you want your money to work hard too. Nothing wrong with that. But the question is really too narrow, because it ignores two things that really matter most to serious wealth. First, can you keep the money? Second, can you still control the money when the pressure shows up? We're talking about lawsuits and other things that can threaten your finances. If you ignore those two questions and you chase returns first, then you can win on paper and still lose in real life. I've seen versions of that story for decades, and let me give you a simple comparison. Imagine one investor gets a 12% return in a normal domestic setup. Another investor gets a 10% return in a better structured offshore arrangement. Now, at first glance, the 12% investor looks smarter, looks sharper, looks like the one that you want to copy. But when we introduce reality, maybe the first investor gets sued, maybe a creditor gets aggressive, and maybe there's a business dispute, a personal guarantee issue, say a divorce, ugly partnership breakup, or a judgment. Suddenly the assets are not just investments anymore, they're targets. And if those targets are easy to reach, part of that impressive return story was fiction. A lower return that is better insulated can beat a higher return that is legally reachable. And not that the returns are lower offshore, many times they're higher. The point is, this is not just finance, this is a financial survival event. So this is where sophisticated people think differently. The Swiss private banking world became powerful, not because Swiss bankers discovered how to bend the laws of mathematics. They became powerful because Switzerland developed a reputation for political stability, discipline, wealth management, and world-class cross-border private wealth management. In fact, I know many Swiss bankers, and Switzerland's financial sector manages roughly 8.4 trillion Swiss franc in assets, including well over $4 trillion in private assets, about $2.6 trillion in offshore wealth management, which helps explain why the country remains a leading global hub for cross-border private wealth. That matters because it tells you what the Swiss are really good at. They are not famous because they promise wild returns. They are famous because serious people trust them with serious money. And that's a completely different thing. And it is a more important thing if your goal is not entertainment, not gambling, not cocktail party bragging rights, but preserving and growing wealth that you actually care about. Now, the Swiss mindset is different from the average American investor mindset. The average investor often asks, what can I make this year? The Swiss mentality is much closer to what can happen to this capital, who can get to it, and what risks are being taken, how is it diversified, what jurisdiction is involved, and what happens in a crisis. And that's a more mature question. It's also a wealthier question. So there is a reason so many family fortunes are lasting longer in places where people think this way. Okay, now let's go ahead and add Luxembourg and Liechtenstein to the conversation, because those names belong in this video. Luxembourg has long been known for international fund platforms and cross-border structuring. Liechtenstein is small, but financially sophisticated, with a long tradition of private banking, wealth structuring, and foundation work. And yes, Liechtenstein remains one of the richest countries on earth by GDP per capita. Depending on the source and method, those figures place it a little above $206,000 US based on the World Bank's latest reported value for 2023, while some 2026 IMF-based rankings put it around $246,000 per year. Now, why do I even bring this up? Not because high GDP per capita automatically means better returns for you. That would be sloppy thinking. I bring this up because jurisdictions like that tend to attract and cultivate a financial culture built around preservation, structuring, and serious capital. And that culture matters. It influences how people manage money, how risk is discussed, and what kind of clients feel at home there. When you place your money in an environment built for serious wealth, you often get more disciplined handling of that money. Okay, now let's answer the returns question more directly. Can offshore investments produce good returns? Absolutely. In fact, I've seen it personally for our clients. Offshore is not a synonym for low return. You can get really high returns, like we've seen. Offshore is simply a legal and jurisdictional context. The return depends on the underlying investments, the managers, the fees, the risk profiles, and the fees. What we found are they're actually quite reasonable, comparable to what the fees are for U.S. money managers. And you tend to get higher returns if your money is managed professionally. We've seen that over and over again too. The asset allocation is also a factor, and how conservative or aggressive you choose to be. Now, you can earn weak returns offshore if the investment choices are weak. You can earn solid returns offshore if the investment choices are solid. You can also lose money offshore if you choose poorly. The ocean is not a magic mutual fund. But here's where the sophisticated answer begins. Offshore can improve your overall financial result without necessarily improving the raw investment percentage. So why is that? Because offshore can change who has leverage over your money. That's the key thing. So if somebody gets you in a lawsuit, they sue you, they get a judgment, and they take all your money, well, that's pretty clear. That's not a very good return on your money. So this is why going offshore in the proper structures can change how reachable your assets are. It can change how much panic you feel when something goes wrong, because the assets may no longer be sitting in a structure that a local court can easily squeeze. And that means you make better decisions, your advisors make better decisions, and your long-term compounding has a better chance of continuing. So that is a real return advantage, even though it does not fit neatly into a one-line performance chart. And that is exactly why affluent people misunderstand offshore when they first start looking at it. They want the answer like this: hey, business guy, if I move money offshore, can I get 8%, 12%, 15%? But the better answer is this: if your offshore structure is well designed, you may be able to get reasonable market-based returns while materially improving the durability of your wealth. That is, you keep the investment intact instead of losing it to somebody who sued you. So that is a much better sentence. It's not as sexy, and because it's not as sexy, a lot of people ignore it right up until they get hit in the face with a lawsuit. Okay, now let's go ahead and talk about what offshore actually changes and what it does not change. Offshore does not magically make a bad investment good. Offshore does not turn a reckless investor into Warren Buffett with a passport. And keep in mind, we can invest in the same stock, U.S. stock market, Apple, Microsoft. So whatever you can invest in the U.S., Canada, Australia, or wherever you are, UK, you can invest in an offshore bank account as well. Offshore does not eliminate market risk. If you buy poor investments, you can still lose money. If you chase nonsense can still bite you. But offshore can change jurisdiction. It can change legal leverage, access to certain managers, access to certain custodial relationships, currency diversification, and the strength of the asset protection architecture around the money. And that's where the power is. And this is where the Cook Islands Trust comes in. In fact, I've been in asset protection for 35 years. I've been helping people establish Cook Islands Trust for roughly 30 years. In fact, the trustees in the Cook Islands tell us that our firm has set up more Cook Islands Trust than any firm in the world. So when I tell you this matters, I'm not speaking theoretically. The reason the Cook Islands Trust matters is not because the trust itself is an investment. It's not. The trust is a legal shell. It's the shield, the control architecture. And the nice thing is, even though the trust is in the Cook Islands, your account can be in Switzerland, Luxembourg, Liechtenstein, or the Cook Islands itself if you prefer. The returns come from what is invested inside the structure, not the structure itself. The structure just protects it from being taken. But if the shield is weak, the investments can become reachable. That is why serious affluent families often need both pieces, intelligent investing and intelligent legal structure. So that's why a properly designed Cook Islands Trust, like we set up, can work beautifully with a Cook Islands LLC inside of it. So you can be the manager, the signatory in the bank account until the quote bad thing happens. So while the waters are calm, you can remain manager of that LLC. In normal times, you can direct investments, work with the advisors, and operate in a way that feels quite practical. But if a serious threat arises, you get sued and somebody's coming after you, our licensed, bonded, trustee company law firm that we utilize and we've been utilizing for years can step in and take over where needed. So that is the beauty of calm time control and danger time separation. You get flexibility when life is normal, and you get separation when danger arrives. And that changes lawsuit leverage in a way domestic investors do not fully appreciate until much later. And here's one of the most misunderstood truths of all asset protection and offshore planning. Control is wonderful until too much visible control becomes your weakness. A lot of people say they want control. And I understand that. Successful people usually like control. But if a domestic court can force you personally to repatriate or bring back money, or can pressure you because everything clearly runs through you, then too much obvious control can become the crack in the wall. The goal is not to feel powerful. The goal is to be hard to pressure. That is not always the same thing. Now let's come back to Swiss bankers, because this episode asks for that angle, and it is a smart angle. The Swiss have some of the best money managers in the world, not because they always swing for the fences, but because they're often very disciplined about risk, diversification, and the long game. They manage enormous amount of global wealth, and major institutions and private banks there continue to operate at a scale that reflects a real trust from wealthy clients worldwide. In fact, in plain English, what does it mean for you? It means that if you're looking offshore, the conversation should be more sophisticated than where do I get the hottest return. It should be, what kind of manager am I working with? How disciplined are they? What jurisdiction are they in? And how stable is the environment? How does this fit inside a protection structure? What are the fees? What are the risks? What happens if I get sued? And how much of my net worth should be allocated there in the first place? So this is how an affluent person should think. Now here's another counterintuitive truth. Sometimes the wealthiest move is to accept a little less excitement in exchange for a lot more resilience. Americans love excitement. We love growth stories, hot stocks, dramatic charts, and heroic forecasts. The wealthy people who stay wealthy for a very long time are often a little more boring than that. Not boring in lifestyle, boring in process. They're structured, diversified, deliberate. They do not need every dollar to perform like a caffeinated gymnast. They need the overall machine to keep running. And that brings us to timing. If you're thinking about offshore planning, waiting until you're already under major pressure in a lawsuit, that could be a disaster. People do this all the time. They spend years building wealth in highly exposed positions, telling themselves they will clean it up later. And then later shows up with a subpoena and bad news. Once that happens, your room to maneuver can shrink dramatically. Offshore planning is the strongest when it's done before the storm. And that is not fear talk. That's just how leverage works. We can still protect you after you're sued, but it's going to increase the price and it's going to decrease the option. So the sooner the better. So one more thing that affluent viewers should really hear, because this is where judgment matters. Offshore is not a substitute for common sense. You still want liquidity planning. You still want tax compliance. You still want the right professionals involved. You still want to understand what is being held where, in whose name, under what authority, and with what reporting requirements. Now, sophisticated offshore planning, it's not sloppy. It is actually the opposite. It is detail-oriented. The people who do best with it usually have the humility to be precise. And let me say something else that really sounds small, but it's not small at all. Emotional return matters too. If you have meaningful wealth and you lie awake at night wondering whether one ugly event can undo decades of work, that's not a minor issue. In fact, peace of mind has value. That's what asset protection is all about, is peace of mind. Strategic optionality, I mean, that really has value. Knowing your assets are not sitting in the easiest possible place for an opponent to pressure you, that has value. If your assets are in the same jurisdiction where the judge resides, well, that could be a big problem for you. People love to act like the only thing that counts is the number on the statement. That's nonsense. The quality of the structure holding the money affects the quality of your decisions, and the quality of your decisions affect your life. So that's why the Swiss frame this differently. Keep in mind, you can go online, you can check your account anytime you want to. You can go online and trade stock with many of the investment houses. So the Swiss are not just managing numbers, they're managing continuity. They are managing family outcomes. They are managing the odds that capital remains intact through bad markets, bad politics, bad claims, and bad behavior by other people. So once you start thinking in those terms, offshore really makes a lot more sense. It stops being some, mysterious, exotic idea and starts becoming what it really is, part of a serious wealth system for people who intend to keep what they've built. I mean, I've walked into many offshore bank accounts. I've walked down Bahnhofstrasse in Zurich, Switzerland, walking into the banks. Very, very, very well run, efficient places, professional. You just feel taken care of. So if you ask me what the truth is about offshore investing, here's the answer. Offshore is not a magical return machine, even though you can get really good returns. It is not a shortcut. It is not a cartoon vault where money becomes richer because it heard an accent. Offshore is a strategic environment. If used well, it can combine competent investing with stronger legal positioning, broader diversification, more stable jurisdictions, and better wealth durability. And that's exactly why the Swiss win. They understand that wealth is not just about managing money. It's about keeping money, structuring money, and making money that much harder for other people to attack. If you remember only one thing from this video, remember this. The best offshore return is not necessarily the highest percentage on a statement. The best offshore return is the return you still own after life. Lawsuits, creditors, conflicts, and pressure have all taken their shot at you. Once you understand that, you start asking a much better question. And once you build better questions, you build a much stronger life. So yes, you can get good offshore investment returns, but the richer truth, the Swiss truth, is that the real victory is not just the return. The real victory is creating a system where the return has better chances to survive and compound. And that's the game affluent people should be playing, and that's the smarter game, and that's why the Swiss win. Appreciate you watching, and we'll see you in the next one.